Can the U.S. export its way out of a slowing economy? Joining us now is Lance Roberts. He's the CEO of Street Talk Advisors, and David Gilmour, Foreign Exchange Analytics. Our friend Steve Leisman back for an encore performance after his brilliant presentation just moments ago. Lance, let me start with you. It's a simple question. Can we export our way out of our jobs malaise in particular?
Well, it's certainly something that is a possibility. It's going to be very hard to try to export our way out. Of course, this is one of the things that the Obama administration talked about very early on in their administration, which was simply, we're going to double and triple exports over the next 5 years to help fix our economic growth problem. One of the issues here, though, has been the falling weakness of the dollar, which the debasement there also impacts the ability of the consumers to consume, but it does help our foreign trading partners to buy goods from us and to export to them because our prices get cheaper for them, so exports look good on their side.
Yeah, absolutely. To that point, David, how much of the strength in exports do you think is due to the weaker dollar? And despite all the big talk about we want a strong dollar policy, actually behind closed doors, they're really quite happy for this to be an orderly decline.
I think they're quite happy that it's an orderly decline. There's so many problems in Europe. There's problems in Asia. So the parachute is on the dollar decline. It's just as the doctor ordered. It is helping exports. I can't give you a precise estimate as to how much the dollar's decline is boosted exports. But really, I think what's important is the red states in the United States, where they're very flexible labor markets, very low costs for producers, are on sale for foreign manufacturers, and jobs are coming to the U.S., and they're coming to the red states. The red states are the new red China in labor markets.
Steve Leisman, however, you really can't devalue your way to prosperity. No. I mean, Steve, the rising energy prices hurt American producers. They hurt American consumers and real incomes. Wouldn't it be better to have lower trade barriers to promote exports instead of destroying the currency?
Absolutely. Larry, you and I have a religious affinity and a religious difference here. We both worship at the altar of free trade. I do not worship at the altar of the strong dollar. I think when I look at the trade balance of the United States being so extreme the way it is, I think there is room for bringing back balance. The United States cannot be forever the consumer of last resort and help emerging markets continue to boost their economies at the expense of U.S. manufacturing and U.S. exports. That said, we do not want a specific policy to export our way out of this and devalue the currency. What we want is we want the right economic policy, the right monetary policy to create the right market-oriented result.
Well, okay, but Steve, some people believe that the falling dollar from QE2, which has jacked up energy prices, that hurts corporate profits, that hurts consumer real incomes, has actually done more harm than good. And those very same people say, let us negotiate the free trade deals to open up opportunities rather than lower our living standards at home.
I don't think those are mutually exclusive. I think we should be opening up the free trade and negotiating these contracts. I just think that when we pursue the right monetary policy for the United States, it has to be one that's right domestically for the U.S. And China complaining about its inflation, what Bernanke said to China was, hey, guys, you got the tools to fix your own problem. I got a big enough mess here at home. Let me handle it.
Lance, also, how much does the weaker dollar really deter foreign investment in the United States to the point where the net negatives really do outweigh the net positives? The positives, of course, we've been talking about the boost to exports, but there do seem to be a lot of negatives as well.
Well, I think the way we really have to look at this is that no country in history has ever debased their way to economic prosperity. The weaker dollar is not something that just started recently. The dollar's actually been declining in value for the last 25 years, which has really been, and Larry will agree with this, he's a big conservative just like I am, is that the policies that we've pursued here has weakened our dollar, and we are depending more and more today on the kindness of strangers to support our America.
Yeah, but will our economy benefit from a stronger dollar, which will hurt our exports even more, boost the trade deficit?
No, it doesn't hurt. That's not proven.
Let me try to get a point in here.
Go back to Steve's point. The last 10 years, really the last 10 years, we've seen about a 40% decline in the exchange value of the dollar. Okay, that's been a lousy period of the economy. The economy has grown by about 1.5%. So if the depreciating dollar worked, my question is, why hasn't it worked? And maybe we should try hard money instead of soft money.
Let me just say this on the debasement story. Every single measure that you would look at for how U.S. credit is priced tell you nothing about this debasement, nothing about a loss of confidence. Treasuries, break-evens, five-year forward.
I'm talking about economic growth, David. Economic growth and job creation has never done better. We've never done worse than we have in the last 10 years.
Of low growth, you would expect you would expect your currency to be weak because it would imply low interest rates.
Or is the weak currency causing the low growth? That's the conundrum. Or is the weak currency causing the low growth? Go ahead.
I think
finish this out, Lance. Finish this out.
Well, the point here simply is that a debasement of the currency leads to weaker ability for the consumer to spend.
Right.
We've had declining wage growth in the United States for the last 10 years. They can spend less. It reduces our value as a reserve currency of the world. More importantly, the trade deficit won't meaningfully decline because 40% of the trade deficit is oil, and that's priced in dollars.
So we've really got to just hope there isn't a disorderly decline of the U.S. dollar.